Welcome to TMC Connect. Thank you guys so much for being here today. My name is Tony Bramley, and I am the Director of Business Development. So excited to have the Maxwell team with us today. We are going to be talking about how to save up to $1,600 per loan by leveraging technology and outsourcing. And we are all waiting with bated breath because we all want to save some money. Before we get started, just want to let you know that you have come in on webinar, so you are on mute, but we want this to be engaging, so please drop your questions in the chat or the Q&A, and we'll be addressing those as we go. And then tomorrow you'll receive a follow-up email. It's going to have a link to the video of this session as well as the deck that the guys will be going over. So once again, thank you all so much for being here. We appreciate you, and without any further ado, I will turn it over to Alan.
Thank you so much, Tony. Well, super excited to be here with everybody. We've been a TMC member for several years now as an organization, and I think always love the interactions and times we can spend with the lender member network. And excited to share a little bit about what Maxwell has going on in terms of being able to help lenders in these challenging times and future growth times. But then additionally, at the same time, provide, agnostic to Maxwell service and solution, some ideas, some best practices, and some approaches to hopefully arm you to find some more margin in the bottom line and set your company up for success. So let's do quick introductions maybe we'll start with Traeger as we get started, and then we can go to AI, and then I'll introduce myself. Just quick background of what you do and where you come from.
Awesome. Thanks, Alan. Brian Traeger, I run corporate development here for Maxwell. So M&A and strategic partnerships, inorganic revenue generation. Prior to this, the most relevant experience that I have for the conversation today is I was hired as part of an interim CEO team to come into a national mortgage lender and take it from losing money to making money. And so we learned a lot of little tricks here and there, and we're able to apply it and successfully go from the red to the black. So excited to share some of those learnings.
Nice. And I'm Anthony Ianni. Everyone can call me AI. So if you already know that, if you already know me, you know that. So I actually started my career in the 1988. So at ComNet Mortgage Services in Philadelphia. But I live here in Denver now and kind of running the desk for Maxwell, and I do a variety of other things. So they, in addition to calling me VP of Secondary here at Maxwell, they call me VP of everything. So anyway, thanks for having us.
Fantastic. And my name is Alan Paris. Pleasure to spend some time with you today. Currently head up our private label product, which is one of the solutions that we have here at Maxwell to ultimately help a lender focus their resources where they feel like they can make the biggest impact and outsource a large chunk of the origination process. Brian, Anthony, and I spend a decent amount of time together on a podcast called Clear to Close that we do every month for Maxwell. If you are in need of a good podcast, you can not listen to that one. I'm joking. We are a good podcast. Give us a listen. We like to have a lot of fun and talk about what's happening in the mortgage space on a monthly basis. Everything from rate economic changes to some of these best practices that lenders can try and hopefully find some impact in their organizations. So head over to himaxwell.com over a resource page and give us a listen.
Alan, shameless plug. We had Michelle on yesterday.
Shameless plug, man. Shameless plug. Yeah, and we had Melissa from Melissa, President and COO of the Mortgage Collaborative, join us yesterday. So episode coming out soon. Before we jump in, what I want to do is share a little bit of context of what solutions Maxwell offers in our and how we approach some of these problems. And then what we'll dive into after that is the latest hot off the press Q3 MBA performance data that has come out around profitability for lenders. So I think it's 2 days old, came out Tuesday or Monday. And so ultimately we'll run through kind of side by side 2023 and 2021 of where are there differences in the P&Ls and where have there been movements positively and negatively that have created the kind of financial status of lenders on average today. As you can imagine through that experience, that is looking at averages. And so we know everyone here probably has very different numbers, very different business models, very different business structures. And so, take it with some broad strokes of themes that may be applicable throughout as we go kind of line item by line item, and then share where we think there can be some gains and how lenders can be solving some of the challenges that they see in their P&L. So I want to spend just a few minutes running over what Maxwell Private Label is. So ultimately, Maxwell as a company provides several technologies and solutions to help lenders in different stages in the origination process. Everything from our point of sale that we originally launched as a company back in 2015, all the way to outsourced processing and underwriting, secondary market capabilities through Maxwell Capital. And then our most recent launch of a product combines a lot of those together into a full outsourced solution known as Maxwell Private Label. What we do at Maxwell Private Label is ultimately allow a lender to shift fixed expenses into more variable per closed loan expenses and focus their resource and efforts in driving borrower demand in the sales functions of the origination process, and let Maxwell's technology and people handle the rest. Ultimately, Maxwell's people process originate the entire loan on behalf of the lender under their guidelines and provide the entire tech stack, including the point of sale, loan origination system, and all vendor relationships needed to originate the process. I give this as an example because this will be something that we reference as a way to really shift your P&L and shift some of those fixed expenses and reduce some per loan expenses as well. But you can imagine many of Maxwell Solutions, as well as other vendors in the space, the ability to start to partner from a technology perspective or from a solutions perspective to share some of the expenses that you have and find a more variable and a more profit-driving model on a per loan basis. So let's start with the trends we've got going on in the latest Q3 report. So ultimately, profitability on a per loan basis dropped further from Q2 from losing $500 per loan to losing $1,000 per loan on average. You can see, I think this is where volume has continued to make a dent and an impact in the shift from Q2 to Q3. However, obviously there's two elements here that are happening. So the kind of worst case scenario from the long-term trend that we have is ultimately revenue continues to decrease on average on a per loan basis, and expenses continues to increase on a per loan basis. I think one thing we wanted to highlight was you look at the kind of time periods of over 400 bips on a production basis. That is the period where I think people were poorly staffed, poorly adjusted on the volume shift. And I think, first off, I think congratulations over this time period of making really hard decisions and shifting and cutting a lot of that expense out of the system. You see a tremendous difference in Q2 and Q3 from a cost to originate perspective. And I think I know many people on the call here probably have had to make some very difficult decisions, some rethinking of how they want to operate as a business, and ultimately setting themselves up for what is a very turbulent and unknown time that we have from a volume perspective. Brian, AI, anything you guys would comment on kind of the high level trends and shifts so far?
Yeah, I think the main takeaway for me is this big difference in Q4 2022 and the early part of 2023, where the variance is pretty large, and it just shows that those fixed costs are being spread across fewer loans, and that's why so many loans, or I guess there's so much loss per loan. So although a lot of decisions were made to right size the cost basis model, it wasn't done fast enough. And you hear that across almost any industry when there are changes that's not done fast enough. The data shows it right here, and it's continued. So it's just an interesting point in time to reflect on, because we are in a cyclical business. There will be a time where this happens again. So it's something to kind of learn from, maybe put it on the shelf and come up with some ideas on how to combat that, and what warning signals we can have, what options are at your disposal to ensure that your business doesn't react to this like it has in the average across the industry.
Yeah. And you're right, Brian, and it's unintended consequences. So we, Fed thought they were doing the right thing post-COVID, but look what happens. And so now we've got, humongously wide spreads and costs are just through the roof. So hopefully we can get that right-sided. Maybe the past couple of days kind of gives us a little bit of a trend.
Fantastic. What we wanted to start with is on the income side of the changes we've seen from 2021 to 2023. Ultimately, big shift in kind of net secondary income as one of the biggest drivers here. Lenders, I think, have reacted in a sense. You see it from a total originated related income, which is, fees passed to the borrowers upon closing, et cetera. A shift to kind of mitigate some of that loss, it seems, kind of going north of, $500, $600 compared to what it was in 2021. But that kind of increase right there is not going to cover the difference that they're seeing on selling these loans on the secondary market. So AI, I would love for you to maybe start off on, you spend your time on the secondary side. Lenders right now compared to 2021, similar loan size for similar loan size are, $1,300 in the hole out of the gate before they even look at the expense base. How can lenders be thinking about opportunities in this space and some best practices to try to find those additional bips along the way?
Well, I use the baseball analogy, and Brian and Alan, you've heard me say this a lot, right? You win baseball games with singles, although home runs are very sexy and fun to watch. You really do it that way, right? And so I'm always a get back to basics person. And it doesn't matter whether you're delivering loans on a best efforts basis, or you're hedging your pipeline, and you're delivering loans on a mandatory bulk basis. There are certain things that you should always be doing. And one of the things that we always do on our desk is we're always asking the question, why? Why is it like that? Why does that happen? Why is that happening? And so I think you should always, there are basis points which we would call leakage. All you secondary folks, if you're on there, you know that, right? So there's leakage everywhere in your pipeline, and you should be looking at it. One of the biggest things is what I would like to call a stage stagnation or status stagnation. So you should be looking at loans that are kind of sitting in your pipeline for long periods of time. For those of you that use Encompass, you have the ability to set up those times, as you know. And so if a loan's sitting too long in processing or underwriting, you have the ability to be notified of that and push it along. And so that's especially important if you're hedging, right? Because if you have a loan that's sitting in the hedge, 30 days later, you find out, oh, well, someone should have told me that loan is dead. You just hedged that for 30 days. And so that goes right to the bottom line. That's money that matter of fact, you should send it to me in Golden, Colorado, and I'll take care of it for you. And so, but I mean, there are things like that too, and they may sound kind of funny and trite, but those kind of behaviors to manage your pipeline and make sure that you're staying on top of extensions and you're spot checking pricing and eligibility to make sure that you have loans that are viable. Those kind of things are going to help you. And so I think as they are things that have served me well, I still do them. My compadre on the desk, Matt, we talk about it and we argue about it all the time, and we both still do it almost on a daily basis.
Now, I think another thing to analyze in your business, well, first is analyze it continuously. A lot of folks, they are just in cruise control. So there's a lot of things within the net secondary income that aren't in, or that could be you're in control, but that you may not think so. AI, you just mentioned a couple that are certainly in your control.
Yep.
We know throughout the years there's margin compression for a variety of reasons. We don't need to go into the reasons of why the market compresses on margins. But within your own business, why could this be decreasing? It's like, all right, average loan size trends. Your product mix, because each product yields a different revenue basis. So it's like, you got to really understand the trends in your own data, how they impact these numbers, because you can certainly do a lot of moves on the secondary side to gain margin or lose margin, depending on how you're looking at it. So when you see trends with average loan size, it's trending down, know what that impact is going to be. Okay, well, then you could transition into analyzing your product mix. Okay, well, why aren't you getting as much FHA business? Analyze the why. Maybe it's within a certain stack of your note rate on the product that you're losing out on relative to the market. Maybe you should go on sale there for a little while and see if it yields more loans. So just constantly analyzing that business, and don't just like listen to the market for the trends over quarters and years. You have to look at it a lot. The executives that I know from the capital market side that do this really well look at it every single day, and they're looking at it yesterday versus the last week versus the last 30 days, and they're every day they re-upload that and look at the trends and make business decisions accordingly. So
and those are great points, Brian. I mean, you know that we look at it internally here at Maxwell. You're part of that group that looks at it, right? So we look at those numbers on a weekly basis, and so that gives us a sense of do we have a pricing situation in lower loan sizes, or maybe are we too aggressive? So I mean, those are definitely things to look at. They're great points.
Again, as we just a reminder, any questions along the way, comments, anything, feel free to put in the chat. We'll try to answer either throughout the conversation or at the end. Do not hesitate to reach out. So let's shift to expenses. Same view, MBA data, Q3 2021 compared to Q3 of 2023. You know, we highlighted a few sections probably worth discussing in this to kind of narrow our focus for the conversation. You know, sales expense, I think that's another topic for another day. For bold people who want to go solve that right now, more power to you. For this point of the conversation, rather than discuss LO comp, huge shifts in how to compensation structure, what payment should be, I think ultimately we're going to leave that as an area that is not going to be solved on today's call. But really want to highlight fulfillment expense, production expense to start with. You know, ultimately, what's surprising in this is, you know, you can see, and the data is not easily to be digestible on this slide right now, but when you look at the past data, really tough decisions were made to right staff the businesses as best possible. But what's even surprising is looking at, you know, Q3 2021 of $1,300 to originate a loan on the fulfillment side. That was with massive salaries in that time period. So it almost, you know, even though it's $1,500 today, it almost probably hides somewhat the difficulty in utilization and efficiency that's probably shown, that isn't showing up in the P&L, but is ultimately still there in the system. And I think that's, you know, when you really think about it, it's at a certain point, you get to a point where if you don't have, you know, 60, 200 and north loans on a per month basis, it's hard to get to that pure utilization that you can get from a fulfillment employee.
Alan, could you further define what you mean by utilization? Because I know that can make it a little bit confusing and yeah.
Yeah, I mean, ultimately, you know, the way we look at operations, and I think it's a pretty standard way to look at it in this space, is what is a team member capable of doing on a daily, monthly basis? How many files can they touch? How many files can they work at one given time? And so we set what we view as a standard, a maximum per employee, and that is different based on a processor, based on a closer, based on a disclosure team member. And what you're trying to get to is that 100% utilization, or, you know, high 80s of utilization of that team member, almost always working on a file quickly and move and has the pipeline coming in, as well as the speed in the file to constantly be working on files. And so you're taking that fixed expense of their salary, their benefits, their 401ks, and then distributing it across a larger amount of loans to ultimately reduce the cost of that fulfillment expense.
Got you. Perfect. Yeah. And so then above 100% utilization would be somebody who's fulfilling and hitting that kind of quote unquote quota, plus doing overtime and hitting a couple more loans. So you can't go above 100%.
Yeah, I mean, you can't go over 100%. I think ultimately, if you start always going over 100%, then you probably have a new standard of what 100% is. But
or you have burnout.
I think or you have burnout. And so, but yes, there are times where you can go over 100%. Mm-hmm. And so I think, you know, as just a frame of reference, I think, like, you know, a fully utilized team, this number is probably in the industry kind of salary averages, and this is again broad strokes, in that $800 to $1,100 range. So there is, I think the challenge that some lenders have is they've already cut a ton and they still can't get it lower. They don't have the loan volume to kind of surpass the smallest base of employees that they can have. Right.
And one of the reasons that we've seen why, and particularly in the smaller or folks that have gone kind of mid-sized to smaller with the current volume market, is as you grow, it's more natural to have groups take on tasks that were part-time tasks for others. Yeah. Disclosure desk is a perfect example. Appraisal desk too. So when you get enough loans coming through, all right, well, let's take this couple hours a week off of all of these processors or underwriters, and let's add it to a group who specializes in it, and let's go. So when volumes decrease and they drop below a level where it's not as economical to host those roles, a lot of folks we've found have kept them and not retrained or pushed, these other people into other roles within the organization, but the roles have kept, and they're not being utilized. And so instead, like, another thing you can think about is, okay, well, let's remove the role. Let's do the exact opposite of what we did when we were scaling, is say, hey, processor, unfortunately, you're going to have to do this extra 2 hours worth of work on disclosures that you historically haven't done because the desk did it. So you really need to think about those, like,
that's right,
volume hurdles in your incremental business model of what you've done to scale up in the times where refi was heavy. You need to look at them going downwards too, and rethinking now, because we've been down for a while, how you're going to scale back up. Yeah. Are you going to create the disclosure desk? Are you going to do X, Y, and Z? Do you really know all of the options that you have? That's why we're here today, is to kind of talk about some of those options that people might not know are at their disposal.
Yeah, that's right. And I think ultimately, you've got to look at your view on volume. And if you have a strategy for step change levels of volume, it might make sense to keep a hold of that team to set up the additional resources. But if you have a world where your volume has stayed pretty consistent of its low mark, and you kind of know on average your growth trajectory in even good rate times, it's not going to get, there's a certain point where the math can't get solved by a staffing problem, a staffing element. It has to be a shift into a more variable cost model or an outsource model if you want to find gains in that section of the P&L. And I think that's really you as a business leader to say, do I want that number to change, or is that an area in that number, because that's a core part of our core competency, that I'm okay staying maybe on the higher side than other lenders. But I think just the big caution is, after you get to a certain point, when you know what your general volume trajectory is, it's not going to really change materially until you start reaching those volume tiers that are, drive that full utilization across a team.
And thinking about it within unique products, like your product mix and the scale of that. So many lenders out there, have dove into HELOCs or other things that they don't typically have in a normal rate environment. So when rates, come back, are you going to keep doing those things? Are you going to start a non-QM group? Are you going to XYZ? Those are things that you don't necessarily have to do completely yourself. Because if it's a bet, it's something new, you guys don't have the expertise, it's really hard to recruit and retain top level non-QM underwriters, for example. You can look at doing an outsourced model to help you scale that arm and say, hey, we're going to, do a lot more business in non-QM. We're not exactly experts in how to do it, so let's funnel it this way. Let's see if that model works. And then using that as a way of a testing ground to go further into your own business model, keep it aside, take it on yourself. It's very similar to folks do that with, hedge advisors. They say, hey, please hedge my pipeline for me. I don't have the expertise. I don't really have, the bank to hire a seasoned hedge trader. But at scale, all those hedge advisors will say, hey, you're eventually going to outgrow me, and you should really have the desk yourself. That's so right. Like, we all need to work together in understanding the optionality that you have. And typically people aren't necessarily looking at specific product outsourcing or growth and scale outsourcing to help them. So it's a good challenge to think about your business model, where it has been, where it's at today, and where you want it to go.
That's right.
I love that idea too, because like outsourcing that underwriting piece to those, we use the word, Tony, I'm going to use that word, I'm going to use that squirrely product again. And so it's it takes a little bit of the pressure out, but also too, there are SLAs in that contract, right? So you have the ability, to say, okay, we're going to have our DSCRs, or we're going to have our HELOCs done in a certain number of days. You don't have to kind of deal with that on the inside. And so now, maybe you can get a few more extra loans through the pipeline in a lot faster time frame than you doing it yourself. And once again, difference between a 45-day and a 30-day lock, a couple of basis points goes right to you. So
right. Just a real quick question in the chat. James, yes, this will be available recorded afterwards, sent by TMC. So no need to feverishly scratch all the notes and do screenshots throughout the time. Just in the sense of time, technology is one that also has increased. Real interesting here is this a increase in investment in technology to drive the results that we see, or is this a challenge that lenders have of Microsoft Office licenses, Salesforce licenses, other technologies that ultimately they don't have the amount of team members that they used to, and ultimately that fixed expense is getting spread across more loans.
Yeah, I think it's a great point in the law of averages being weak. So it's unique to anyone's own P&L. Maybe you are spending too much on certain things. Maybe those costs have increased, but a lot of times what we've noticed, and in the example where I was, and we went into the company to change it from losing money to making money, one of the biggest things was Microsoft Office licenses not being utilized. So they bought, call it 500 of them, but they only used 300 of them. So they're just wasting this money. So on a per unit basis, you're paying almost 2x what you normally would in a normal time. So go look at all of those things, all your vendors, and kind of take a peek. And it's unique to everybody. It's really hard to pull on trends in that cohort of cost items. So do the homework, dive in, figure out what you can do.
So ultimately, what you see from Q3 2023 compared to Q3 2021, around a $2K increase in expenses. So we've got kind of this $1,300 bogey in the beginning from a revenue perspective, $2,000 increase from a cost perspective, really kind of leaving a challenge compared to 2021's numbers. So
volume solves all problems, right?
Volume solves all problems.
Yes.
Which is a huge problem, and something that we shouldn't say, because you should be solving these problems always.
Yeah, and so maybe that's a good transition. Thanks, Traeger. I'll throw you the $20 bill.
Damn.
What
only 20?
Brian doesn't take much. He's living in Minnesota now. He's not living in Colorado anymore. Lower cost of expense. So it doesn't take much to swoo him. What I want to spend the last few minutes talking about is, we talked about a few solutions of how they can shift the P&L. Again, this is on compared to the average. So every lender is going to be different. Every lender has a different cost structure, a different staffing structure for their businesses. But ultimately, want to share a little bit about what private label can change in a shifting of fixed expenses as well as variable per loan expenses to really shift a lender into profitability if they're kind of right on that mark of being right under the mark. And so ultimately, as walked through in the explanation earlier, private label really shifts a lot of that fulfillment and production support and management support expense to Maxwell. And so really what the lender starts to focus on is driving the demand and driving the sales of their operation, engaging with their bar, engaging with their client base, and driving that demand, and a less kind of time and less fixed expenses and less resources on the operation and the origination of the loan. And so along with this reduction, ultimately you see reductions along the way in, equipment expenses, benefits expenses as well. So, there's a direct impact, but then there are kind of ancillary impacts from reducing the shifts there. As we say this, I know this is for some people uncomfortable and some people comfortable on their level of outsourcing. And so this really, I think, is a model where you really need to evaluate what you want to be as a company and what you want to focus on, and determine what you want, to Brian's point, what you want done in-house and what you want done by a partner or out of house. And so really with those shifts of expenses, The thing that does increase is what you're starting to do is you're starting to pay for, from an outsourcing perspective, a per loan fee for every loan that is originated successfully. And so you're kind of shifting this base of employees and technology contracts and fixed minimums and shifting all of those expenses to a per loan originated fee. Ultimately, what we see on average in these is around a $1,500 to $1,600 savings. This can be higher for some lenders. This can be slightly lower for some lenders, depending on how you run your operation. But I think as something to think about as a maybe a far point of what your model could look like, and then use some of our analysis that we provided today to start to say, what are the elements that I could start to think about outsourcing or having a partner do for me in shifting some of your P&L expenses, shifting more away from the fixed expense and more to the variable expense that you can predict on an ongoing basis. Brian, AI, any last thoughts, opinions, anything?
I think you covered it. I mean, $1,300, $1,400, that could give you a couple of extra basis points to on your rate or your pricing to the field. So, I mean, if that makes you a little more competitive and you can get those loans, you can get a couple of more loans in your pocket at the end of the month by giving this strong consideration, I think you have to look at it.
Yeah, I think that's a really good point. AI, like we're here to help, drive some economies of scale down to our customers that either help them from the corporate P&L stay alive, be more profitable, or just be profitable, period. Also hoping that some of those economics drive it down to the rate sheet so you win more business and it helps borrowers. So we fundamentally believe in that. And if the world is just a player of the largest of large lenders out there, I think that would be a scary world. So we really like helping the communities. And so this goes a long way in helping drive down costs for the community folks, as well as those borrowers that are in those communities.
Got it. Yep.
Well, we try to squeeze a lot into 30 minutes and we went over already. So I'll take 5 minutes over as a success. So ultimately, if interested, would love to learn more and continue to talk to lenders in the network. If they're interested in a whole kind of outsource strategy, or even just a part outsource strategy, or how technology, some of Maxwell's technology could help in some of the problems they're trying to solve. So don't hesitate to reach out to us or visit us at www.himaxwell.com. And we'd love to talk to you and kind of have an honest view of your economics and see, are there areas that we can help, or are you in a spot where you're running at a high utilization, a high efficiency, a really well balanced P&L, and are set up for success on your own.
Thanks, guys, so much. I have one question. It's like, so this is a big decision for lenders to make.
Yeah.
So in the conversations that you have when somebody says, I'm interested in talking about this, what type of information do they need to bring or be willing to share with you in order to do this analysis for them?
Yeah, that's great question. I think it's really an understanding of, what does my team look like today? What is my loan volume, and what is my strategy? How much of it is a portfolio strategy? How much of it is a secondary strategy? And then we can really give an honest view of, hey, here's what this world looks like with Maxwell Capital as one of your secondary outlets, if that's a part of your strategy. Here's what we think we can do from a cost savings perspective on a per loan basis compared to where your team is right now. And I think the coming into that conversation, it doesn't have to be the exact the full official financial statements, but is just broad strokes of, what's the team look like today? Where's their kind of a lot of resources that they maybe think are areas that they could pull resources from.
It's an easy process. That's awesome.
That's right. It's the mortgage business. Nothing's easy.
Well, I'm sure that you guys make it as easy as you possibly can.
That's right. That's right.
All right. Well, great. Thank you guys so much. Thank you to Maxwell. You guys are an amazing partner for the Mortgage Collaborative. We really appreciate you and all the ways that you look to try to save the lenders money. So thank you very much for that, and the excellent presentation today. Thank you all so much for stopping by. We appreciate it, and look for that email tomorrow with the follow-up with a link to this video, as well as the deck that the guys were talking about. So thank you all so much. Have a great rest of your week, and happy Thanksgiving for next week.
Thanks, everybody. Thanks, Tony.
Thank you.
Bye.
Have a great one.